specifically, they did say, we don't want to give up that which we do know.
For that which we don't.
To focus on that which we don't know.
That hit me hard too.
Yeah.
Actually. So if you find a good business, it doesn't really matter what the macro is doing.
Welcome to Compound Everything, where we talk money, markets, investing.
And today we're talking about Berkshire Hathaway.
Yeah.
Annual meeting 1994, part 2.
Yes, so this is I think we picked up at the hour and 20 minutes and we went to the 2 hour and 20 minute mark for this video.
So the point of the video today is just to discuss our takeaway points from the Berkshire Hathaway meeting from 1994. And it's been an interesting exercise so far.
Yeah.
Just trying to glean wisdom from the masters of investing, Warren Buffett and Charlie Munger.
Yes, and we said last time that it was nice to go back because in 1994, and I'm going to guess earlier, but we haven't gone further back than that, they were much more candid in their answers.
For sure.
And so that's given us much more information because they're not dancing around questions.
Right, avoiding things.
Like
and they answer them a little bit more quickly than they do now.
Yeah.
And the other thing that's been interesting is to see how business decisions they made in 1994 actually played out.
Yes, that's been really fun to look back at what they've done and then to look now at where they are and to see.
I mean, if our viewers want to, if they haven't checked out part 1 yet, check out part 1. But one of the things that was interesting to go back and see was their confidence in a couple of the shoe businesses that they bought that maybe didn't work out so well as opposed to some of the other businesses that a shareholder had discussed, which were Nike and Reebok.
Yes. 1994 is quite short. It was only 3 hours and 20 minutes in whole, like in
its entirety, yeah.
I think
including the business portion.
Including the business portion. I think now it's much longer than that.
Yeah. I think it seemed longer.
It seems long when you line up at 4 a.m.
That's right.
So maybe it's just the waiting that's a long time, not the actual meeting.
That's true.
Okay, so we may as well jump right into
Let's jump right in. So
we took away from the second hour of...
One of the things that they talked about that I thought was fascinating was diversification. Someone asked them a question about diversification and do they have any desire to be diversified into other markets other than the U.S.
Globally. They were asking about global diversification.
Right, because their fund was, well, not their fund, but the Berkshire Hathaway is getting larger and they're, if they had, lack of opportunities in certain places or in the U.S., was there a general desire to invest outside of the U.S.? And in a sense, they said no.
Yeah.
He said they really don't have any...
Well, they said it's neither here nor there.
It's neither here nor there. They'll go where their opportunities are.
It's not no.
Yeah. So they go where the opportunities are, but they don't think they had much desire to invest outside of the U.S. If they could help it. But they, in a sense, the answer he gave was interesting because he said, we are already, in a sense, diversified. So he used 2 examples. He used the example of Coca-Cola and Gillette.
Yeah.
And so what he said was Coca-Cola, 80% of their sales come from outside of the U.S.
Yeah.
So in a sense, they're already diversified. So they're gaining that advantage anyways. And then Gillette, I think he said it was 70% of their sales came from outside of the U.S. So he said, well, I'm not sure why we need...
Right, because the revenue streams were already coming from outside of America.
Right.
So they already had global exposure.
Right.
Kind of.
Yeah.
Yeah.
So for them, it was neither here nor there because the businesses they were invested in were already making money from outside of America. Also, they, granted they did have holdings at the time in Guinness, which he brought up. So they gave 3 criteria of what they were looking for.
Yeah.
In that sub point, they said a few things.
The companies we look for have to be.
They have to be businesses they understand.
Yeah.
They have to be run by people they like.
Yeah.
And they have to be priced attractively compared to their future prospects.
Right. And it didn't matter if it was here or Europe or China, as long as those 3 things.
Those three criteria were satisfied. So they had to be businesses they understood, run by people they like, and priced attractively.
Yeah.
So those are selection criteria.
Yeah.
So I thought that was quite interesting.
Yeah.
So the next point, a shareholder asked them about their how they factor in macro considerations into their investing decisions. I thought it was an interesting question because, I mean, macro is always on our minds, but this being June the 20th, 2022, it's really on our minds right now because the macro seems to be kind of blown up with interest rates going up.
And I feel like with quick news, fast news, macro makes for good headlines.
Oh, for sure.
So there's always so much about the macro in the news, right?
Yeah.
people who aren't even into investing or economics tend to know a little bit about the macro right now.
They're talking about interest rates, and they actually talked about interest rates.
Yeah,
we'll get to that a little later. What did they say about the macro? What did you take away from that?
Okay, so I took away that they just don't care.
Right, they don't.
Or I shouldn't say they don't care, but it doesn't affect their investing choices.
Right.
One of the best things that they said was that they don't want to give up what they do know, which is the business, the fundamentals, the numbers, to focus on what they don't know, which is the macro. Right. And they went on to say, like, they don't know perfectly what's going to happen in the business, but probabilistically, they have a really good idea within the business. Right. But they don't know they don't know how long wars are going to last. They don't know how long low interest rates are going to be, how quickly they'll raise interest rates, what inflation's going to do this year, what it's going to do next year. So why would they trade what they can look at and know with some certainty to something that they can look at but not really know with any certainty?
Yeah. Well, I think they've said they want to pick businesses they know are going to be around in 10 years, or what are their earnings going to be in 10 years or whatnot. They can calculate that with better certainty than knowing what the interest rate is going to be in 10 years. So they didn't say that specifically, but that's kind of the inference I took.
Right. But specifically, they did say, we don't want to give up that which we do know.
For that which we don't.
To focus on that which we don't know.
That hit me hard too.
Yeah.
Actually. So if you find a good business, it doesn't really matter what the macro is doing necessarily.
Right. And the reason they say that in that question is because the time horizon.
Yes.
I'm not sure if this was the question because it came up.
That was a
certain people ask similar questions. And there are similar answers, but at one point he says, you could go through, he was talking about a company in 1800s. I think that is much later.
It was Berkshire.
We can touch on it now. It was Berkshire.
It was Berkshire.
Oh, geez. Okay.
Yeah, so it was Berkshire. He gave the example of Berkshire.
I must have tuned out for a while.
Well, he said Berkshire, when it was at its inception, I think, or thereabouts, was about, the whole market cap was $2,000.
Right.
And he said you would have gone through 2 world wars, a Great Depression, and a few other things, and maybe you should wait to buy Berkshire stock. And at the time of the interview, Berkshire was 50 billion.
Right.
So it went from 2,000 to 50 billion, despite having 2 world wars, a Great Depression,
and on and on and on.
And on and on and on.
Right.
And add to that now a Great Recession. Now it's worth about 600 billion.
Right.
So you don't need to pay too much attention to the macro with a great business.
When your time horizon is very
long. Yes. Yeah. So one of the takeaway things that they said under that subpoint was, and it's not an exact quote, but relative. He said, "Be agnostic to the macro, but study the business."
Right.
So if you find a good business, so be agnostic to the macro and study the business, and you'll do fine.
I think one of the questions that really stuck out to me was, why don't you go into the private markets?
Yeah, that was the next question. The next
question, right? So why don't you go into the private markets? Why do you do so much in the public markets? And I think he went on to ask, like, what is better? What do you like?
Right. And I think that was they based the question about tax considerations.
Yes, it was.
Because there was preferential tax considerations for buying whole companies as opposed to just stocks, pieces of a company. And so they said they'd rather buy, for tax purposes, buy private, like, and take the whole company. Like that would be their preference. That would be their preference, to buy all of the company rather than little pieces of it. Yeah. But oftentimes, and you continue on. Okay, and oftentimes they can't. Right. Because an owner of a business knows its value. Right. So they can't get deals in the private markets like they can in the public markets. So because public markets are traded in and out and people treat it like a piece of paper to be traded. Yeah. Oftentimes. Yeah. An event happens. Yeah. Right. Whatever it may be, and it causes a company to go on a major sale. Right. And they can jump in and buy a lot of shares at a good price, and eventually that company's shares will. Yeah. Go back up depending on the fundamentals of the company. But in private, I'm not going to sell you my business for a steal. Right. Because I know what my business is worth. Because you're an educated owner of the business. Right. Exactly. And so I also have a vested interest in that. Well, and the other thing I think they quipped is you wouldn't want to buy a whole business from someone who's willing to sell it to you on the cheap, because they know for the way they do things, they look for managers who are going to continue on with the business and continue running it. You don't want a fool running it. Exactly. Who's going to sell it to you on the cheap. Exactly. Either A, he's dishonest. They didn't say this, but either A, the implication is either A, he's dishonest, or B, ignorant. So you don't want either of those people. Or the company's going down, and the guy he's like, I want to get out. You just want to get out, exactly. I want to get out. Yeah, so I found it really a really good point. Exactly. The point being that you can find better opportunities in, even for them, they can find better opportunities in public equities. Because of your rational behavior
of humans.
Right.
Like humans are just so irrational. It gives them such opportunity.
Yeah.
And I know sometimes you say to me, like, you can make money off of the stupidity of people. And,
yes.
And that's essentially what
right.
Buffett was saying there.
For sure. Yeah. Like the irrationality of people is something they capitalize on. And then, in, like you said, in the private markets, you don't get the same opportunities.
And what was also interesting was he said he actually would prefer private.
Yeah. But it's quite nice to hear that as a private or a smaller investor, because
we have no access to be like angel investors.
Exactly. Yeah. And we can't necessarily buy whole companies.
Yeah, we don't have the capital.
We don't have the capital to do that. But if there's equally good, if not better, opportunities in the public equities market, we can capitalize on that as small investors. So that was encouraging to hear.
Super encouraging.
So even from someone who had the opportunity to do both.
Exactly.
So one of the other questions I appreciated and was someone asked Warren Buffett his, call it, impressions of risk or his thoughts on risk. And I think this shareholder said, like, you seem to view risk differently because you viewed derivatives in a certain way, and yet you've bought a huge interest in Salomon Brothers, which uses derivatives constantly. You also insure against things like hurricanes with your insurance business and things like that. And so he's like, what are you seeing that we're kind of not necessarily? He said risk is inextricably linked to time horizon.
Yep.
So what he meant by that is the longer your time horizon, the less risk matters. And he used the example of buying Coca-Cola shares. He said if you bought shares of Coca-Cola back when they bought it, and I think it was in the 80s or 90s, I can't remember, I think it was in the 80s. When you bought Coca-Cola at the prices they got it for, the risk was nearly zero of making that investment.
They got it for next to nothing, I think.
Right. So the risk for them was nearly nothing. But he said if you buy Coca-Cola this morning and then plan to sell it at the end of the day, that's a huge risk because there's a 50-50 chance you will be up or down. You have no idea. So the time horizon matters significantly to them. The other thing he said was, when speaking about insurance policies, but it's probably the same thing when buying securities and whatnot, is that because they have a long time horizon, things have time to play out, and they base it somewhat on probability.
I think he said a decade.
Right. They look at writing policies for a decade or even more. What he said was when they're kind of writing insurance policies, he said on any given day they may lose some money. And in every given year they may lose some money. But over a 10-year horizon, they're looking to make money over time.
Yeah.
So it's the same thing with the equities markets, really, if you really think about it. On any given day, your shares may be up or down. Any given year, your shares may be up or down. But hopefully over a 10-year holding period, your shares will be up.
Yeah, and he said it's the time horizon as to why they don't really worry about beta.
Right.
He said beta only matters if you're in and out of the market pretty fast.
Right.
He said, but if you're a long-term shareholder, beta does not matter at all.
Doesn't matter one iota.
Yeah, and he said so risk is I think he said risk is directly linked to your time horizon.
Essentially, yeah.
And that makes a lot of sense.
For sure. Well, and one of the things he said, he quipped about why beta is silly is because he said a stock going up 20 to 80% per year actually would be deemed more risky than a stock that's consistently going up 5% per year, which is lunacy, right?
Yeah, exactly.
Which would you rather have? The stock that's going up between 20 and 80% or the one that's going up consistently 5%?
Exactly.
So beta as a measure of risk doesn't make much sense to him and Charlie.
Because their time horizon is so long. And then to wrap it up, of course, he asked Charlie
what his thoughts were.
And generally, Charlie says, I have nothing to add. Yes. But here he says, much of modern finance theory can only be described as disgusting.
Disgusting, yeah.
And that was his final remark on the question of risk.
So one of the things that Warren said, just along that same subpoint, is the key is to base investing decisions on probabilities.
Yep.
Basically. So that's everything they do, whether it be in writing insurance policies or investing in stocks. It's all based on probabilities.
Yeah, and he kept bringing up that word probability a few times.
I think he mentioned it about 4 times throughout the whole meeting.
Yeah, so I think the meeting was 3 hours, 20 minutes.
Yeah.
So
it got brought 4 times or so.
Yeah.
So that's just a takeaway. As investors, look at the probabilities. Yeah. That's the base. So the next point he said was he talked about interest rates, because I guess interest rates back to interest rates, because I think interest rates were probably a big thing in around 94. Because
they must have been, because people kept asking about interest rates. So they must have been quite the they must have been quite the topic, probably in the news like they are now.
Well, as we talked about last time, there was a shareholder who asked them whether he'd contact Mr. Greenspan to avoid
to
stop hiking interest rates.
Yeah.
So I guess there was an issue at the time, but he said that there's, the way I took it was, there's kind of 2 points to his answer. He said that absolutely the value of any asset is going to be impacted by interest rates, right? So the higher interest rates go, the more that people will demand from securities and
we're really experiencing what that means right now.
Right, and we're seeing interest rates go up and the stocks are going down in parallel to that. I think in not this interview, but he's also described interest rates being like gravity to stocks, and that makes sense, right? But he also said that there's that part of things. But he also said you have to factor in how interest rates will impact a specific business.
Right.
Will it help or harm them? Because
I think he said different businesses are affected differently by interest rates.
Exactly.
So you as an investor have to be aware of that.
Of how interest rates going up is going to affect the business you're either owning or looking at.
Exactly.
Yeah. And so there's 2 parts to that question. Right. And he said it's not sometimes so easy to figure that out.
Yeah.
I guess.
And the interesting thing is he actually gave a really simple definition of investing.
Yeah. And this was good.
Yeah, in that when someone asked that question, it was one sentence, and I'm just going to read it so I don't mess it up. Okay. All investing is transferring somebody a sum of money right now for an expected stream of money to come later over time.
Right.
That's it. Yeah. It's the simplest definition of investing.
Right.
And it just was there. Right. You just said it as a sentence without thinking.
Yeah. Well, and that you can see why then interest rates will matter in terms of causing things to be revalued. Yeah. Right. Just on that basis. Because if you can expect to get a higher interest rate in the future, you're going to demand more from something that's a little lesser.
And that is why they use the risk-free rate.
Right.
Right, because the risk-free rate is almost 100% certain.
Right.
Unless the entire country fails.
Exactly.
So in America, the risk-free rate is 100% certain. So therefore, if that risk-free rate goes up, you're going to demand a higher return.
Return on your investment.
Right.
From something that's maybe a little less certain.
Because of the probabilities are not 100% on a company.
Exactly.
Yeah.
They may approach it, but they're not.
Exactly. So someone asked them about the cash that they have, and if they are looking at the macro environment, and they kind of use the macro environment as a gauge to when to deploy their cash or not. And I think at the time they were sitting on $1 billion, they said.
I think in cash,
In cash. They had $1 billion in cash. And his answer actually surprised me, so you can expound on that.
And they basically said that if they're sitting on a pile of cash, it's because them as management has failed to identify any good investment opportunities.
Yeah, he said that.
Yeah.
He said, we failed. If we're sitting on cash, we have failed.
We have failed.
I was always under the impression that they held on to cash waiting for the right time or environment, because just from listening from other people. But he actually says if they have cash, they failed to find something. They don't like it.
No, they don't like sitting on cash.
Yeah.
They view it as a failure if they're actually sitting on substantial sums of cash. And he said, well, because of the success of their businesses, they often end up in cash. And if they can't find things for a while, they're not sitting on more and more and more of it.
And he said him and Charlie are always looking because they don't want to. And I think what really struck me in his answer to this one was he said, when you have cash, you're more likely to make a careless mistake.
And he
right. He said the best positions that we put our money in is when we have to sell another position to free up capital to invest in this position.
Because it makes you think twice.
And that really struck me. The worst decisions you make are sometimes when you have cash on hand because you become careless.
When I think of that in our own portfolio.
I was going to say, I've experienced that.
Yeah, so if I'm going to sell stock X to buy stock Y, I really have to double back and think, is stock Y really a better business than stock X?
Because you've already done your homework on this stock, because you've put money in it and whatnot, and now it's like, should I sell this company probabilistically, is this company going to have a better return at this point?
Right, or have a better future, brighter future than company X's that I'm selling.
And the amount of cash too, right? Like if you only have some cash, you're also a little more careful.
Yes.
When we first started out, it was like, do we, don't we? We made fewer mistakes. Less mistakes because
with
we
less
were
money
because we were more careful.
Yes.
But now you get this idea like, well,
I can invest a little here, put a little there. Yeah. I can. So this business may do something, it may not.
Yeah, I totally see what he's saying. When you have a lot of cash on hand, you could be susceptible.
Yeah.
To being more careless. So you have to be careful.
discipline is key in investing.
Yeah.
You know.
And obviously Charlie and Warren are disciplined, which is why they don't throw money at bad investments. But psychologically, that was a profound statement.
Yeah,
that I've never thought of before, and I'm gonna actually write that down somewhere.
Yeah.
So.
Well, exactly.
It's so good.
It is good.
Yeah. So one of the questions was about Freddie Mac and Fannie Mae.
Yeah.
And it was just about the duopoly and whatnot.
Mm-hmm.
And there wasn't much to say about this, but one thing he said is just because a market share is growing for a company doesn't mean it's a good company.
Right. Yeah. Fair enough. Yeah.
So that was just a side comment. I was like, oh, that's something to keep in mind. Just because a company is gaining market share, it doesn't necessarily mean it's a good investment.
Right. Oh yeah. No question. Yeah. I thought it was.
So that was just like I said, not much on the question.
Yeah.
But
they also spoke about the speed of information. Mm-hmm. That's shareholder.
That's a really good question.
That was a good question. One of the shareholders asked whether they thought that impacted things or not, and essentially they said no. It doesn't matter how fast you get the information necessarily. And I think part of that has to do with their time horizon.
And the way they invest. It has really affected day trading. And
for sure.
swing trading and all that. But for them...
For them, not so much. And they said here that the most important thing is what you do with the information you're given, not the rapidity with which it comes, right? So I'm also thinking of John Templeton, who actually ended up moving to the Bahamas, and his returns actually got better the further he moved from Wall Street. Yeah. His information got to him slower.
Yeah.
So it wasn't a matter of how fast he got the info, it was what he ended up doing with it that
And
matters.
I think Buffett said in this annual meeting that he could get the information on a company 2 to 3 weeks after everyone else got it, and he was confident that it would make zero impact on Berkshire Hathaway.
Yeah. So just because information is more available and comes faster now doesn't mean that it puts you at an advantage or disadvantage.
Yeah. I actually think the fast information for people who are consuming it all right away is a disadvantage.
Yeah.
Because you don't have time to really sit and think on it.
Right.
To dig deep. Instead, a lot of people don't dig deep anymore. Right. They read a few headlines.
Right.
And that's it. But Charlie and Warren, they dig really deep. Yeah. Right? And that takes time.
It does take time.
And so it's not the speed at which they get the information, it's how deep are they going to dig with the information they've been given. So at one point, someone asked them about buybacks. And their answer was pretty what I would expect, but it's always good to hear them say it if you're invested in Berkshire. They said we would do buybacks only if Berkshire was the better deal at the time. And then he said, and this caught my attention, it's often not. Because our shareholders
are smart
and
don't sell.
Exactly. Yeah. So I like that. That was good.
That was a good point. And he said things that would lead Berkshire Hathaway to drop in the market would probably lead to better opportunities elsewhere. So if Berkshire's dropping, then there's a good chance their shareholders are going to keep holding on to their shares because they trust Charlie and Warren, and other things will probably be dropping further and present better opportunity.
Yeah, I also appreciated that question because now, being 2022, they have been buying.
They have been buying back shares, which I thought was interesting.
Yeah, me too. Yeah. Which means that they don't think that there is a better deal out there right now than Berkshire. Right. Which means, and this is not investing advice at all, but maybe we should be buying more Berkshire stock right now. Because according to the answer in 1994, if we are buying Berkshire stock, that means there's nothing else in the market that is a better deal than our.
Now they have been deploying some capital lately with some of their more recent purchases.
Yeah, they've done Oxy and Apple and whatnot.
Oxy, Apple. They also bought HP.
They did that insurance.
Allegheny.
Yeah. But it was just interesting knowing that they have recently done quite a few buybacks.
So I'm not sure if their philosophy's changed there or what, but it was neat to hear them say that anyways.
For sure.
Yeah.
Another thing that they kind of went on a little tangent when that person asked about buybacks, and they were saying, a lot of people, this actually made me laugh. They said, some CEOs will give you a number to the 8th decimal point or something like that. And they'll give you a different number every year until they go bankrupt. Right. Of what the intrinsic value of the company is. Yeah. Yeah, and so I guess because she also had asked what is the value of Berkshire?
Right.
And they weren't going to give.
Of course, they weren't going to say
that takes out the fun. I think they said it takes the fun out for you.
We don't want to take your fun away, basically.
But I kind of chuckled because that was a tongue-in-cheek remark, and then Charlie said, "Beware of people who give you numbers."
Right. Yeah. Right. Well, they gave the example of a guy who gave numbers all the way until he did go bankrupt.
Exactly. He always had what his company was worth right up until it went
bankrupt. Right up until it went bankrupt.
So that was just a cute story.
It was a funny story.
I love their breadth of knowledge.
Oh, it's incredible.
They just have so much business experience.
Yeah.
That part of what makes their question so great is that they can just pull from
draw
all these stories.
So many different places.
And
absolutely. Now, one shareholder asked his impression about Peter Lynch and the 2 books he wrote, and Warren said that I've met Peter Lynch. I think he said I've played bridge with him and whatnot, and he says he's a stand-up guy. But he said that Peter Lynch, the way he does things is a little different than Berkshire, obviously. He says, I'm going to paraphrase him. He says, Peter Lynch owns more companies than I can name. And so he says that works for him, and that's okay. And he said there's many ways to kind of get to the promised land, so to speak. And Peter Lynch found one, and they're using another one. He said,
in investing.
I don't think that, in investing. He said, I don't think I would do as well as Peter's done using his methodology. And he wouldn't likely do as well as Warren and Charlie have using theirs.
So to extrapolate from that, we talk about this often between the two of us. It's very important to finding investors. It is very important to find an investing strategy that works with your personality. And what Buffett was saying, for my personality to have that many stocks, it wouldn't work. But for Peter,
it worked obviously phenomenally well.
It worked phenomenal. So he's like, why would Peter Lynch change that?
Right.
And why would I change my way? Right? And I think Bill Ruane has also he's quoted as saying the only person who's made money holding a lot of different companies is Peter Lynch. So Peter Lynch just knows how to do that.
It works for him. It's his investing method, and it works.
And so that resonated with me because you can coattail, and I believe firmly in coattailing and copycatting, but you still have to find your style.
Right.
You're not going to be exactly the same, even if you coattail. There's going to be a few differences because you're different.
Right. You can invest like Warren Buffett, but you're not Warren Buffett.
You don't have the capital.
Right.
Probably.
Right.
Right. You don't. Most people don't.
You don't have the experience he has necessarily.
The education. The friends. Right. And you're also just a different person.
Yeah. You don't have the same psyche and temperament.
You might not have the same.
You may
goals.
have strengths and weaknesses.
So that just resonated with me because I was like, even the investors who are similar to each other, because Lynch has a similar investing philosophy to Buffett, great companies. Right? They still were very different.
I think the overarching theme of value kind of is what permeates through everything. Whether you own, 4 stocks or you own, 100 stocks, it doesn't matter. But I think the thing that does matter is you're buying value at the bottom line. So
and I think that's probably a good place to wrap up the second hour
for sure
of the 1994 meeting.
So I think that's a great way to wrap up our discussion and on a high note with Peter Lynch.
Peter Lynch, So at that meeting, now you had Bill Ackman ask a question, and then you had reference to Peter Lynch. So it's really fun to just go back and listen to these.
Absolutely, absolutely.
So if you enjoyed this video, like and subscribe because it helps us out. And leave comments.
And we'll get to part 3 next week.
Hopefully.